Hi, this is Mike Palmer with Group 1 Trading. This is the Institute Volatility Sonar Report. We are in the midst of what is a very low volatility market by any historical standard. We've had the VIX under 15, closing every day under 15 for something like 85 consecutive days. It's the first time we've seen that since 2007. In addition, we haven't had a down day in the market of over 1% in something like 110 days. It was the Comey letter, if anybody remembers that, was the last day the market was down more than 1%. So we're in a very, very quiet market, but that doesn't tell us that you're not seeing a considerable amount of hedging and people buying upside calls in the VIX because volatilities are so low that protection is cheap. Now, a big trade we see in the VIX a lot lately is what we call a collar, and it's really a three-way. They buy a call spread to sell a downside put. In this case, they bought the April 15-22 call spread to sell the April 11.5 put. They paid 25 cents to do that. They did 50,000 of those. That's a very common trade. Obviously, you're buying a call spread that gives you upside, and you finance it by selling a put, which is also an upside trade. And if volatility were to stay where it is, you would expect that put really not to gain too much value as that future got lower and lower in this quiet market. It's hard to say what's going to knock us out of this really low volatility environment, but I will tell you that it is regular paper trying to buy, regular customer order flow, trying to buy upside calls from anywhere from 2 to 6 weeks out in order to brace themselves for what they would expect would be eventual some type of volatility to pop into the market. So that's what's going on here in the VIX. This is Mike Palmer with Group 1 Trading, and this is the Institute Volatility Sonar Report.